Hello everybody, welcome to the 28th episode of me learning how to trade using Forex. So in the last video we went through the 3 dive pattern lesson on the advanced technical analysis course on the official forex.com, and now we're currently doing the our favorite fib course, or lesson sorry. So yeah, let's get started. Our favorite fib. Here's how to build a trading strategy around Fibonacci ratios using our favorite fib. Our favorite fib is a momentum strategy that works using Fibonacci ratios. We love it because you can use it on various time frames. It works across all major markets. You can use it on a bull and bear markets. It provides a lot of opportunities. You will, however, need to find a market in a clear, strong trend, ideally one that's hitting new all-time, multi-year or multi-month highs or lows. You will, however, need to find a market in a clear, strong trend, ideally one that's hitting new all-time, multi-year or multi-month highs or lows. Well, that's going to be a tough one, I think. Time frames. Most traders use this strategy on 1 hour to 4 hour charts. Although it can also be effective on daily charts or on time frames as short as 15 minutes, it is generally more effective on longer term charts. However, it's often a good idea to zoom into a 5-minute chart when planning your entry. Right, okay, so components of the strategy. This strategy combines everything we've learned about Fibonacci retracement and extension levels. It involves finding a market that's undergone a slight move from A to B, then retracted back to C. A slight move from A to B, then gone down to C, and then D. So that's A, B, C, D trade. You then look to trade part of the extension of the original move from C up to D, entering position when the market passes beyond B to new highs or lows. For this strategy to be effective though, you need momentum. That means that the retracement to C must be shallow and relatively quick, not like pow, pow. If the BC line moves beyond 50% of AB, or too much time elapses, then the entry signal is not valid. Otherwise, you can start to plan our position at point C. Trading our favorite fib. At C, you can decide your entry, risk management, and targets for the trade. ABC, less than 50% retracement of A and B, stop below B, discretion is required, entry above B, first target 127.2% of BC, second target 161.8% of BC. Entry, as we've covered, you want to enter your position once the market moves beyond B, then ride the move towards D. So as we covered, you want to enter your position once the market moves beyond D, B, start above here, then ride the move towards D. If the market is in an uptrend, you'll want to buy a few points above B. If it is falling, then sell a few points below B. You can choose to do this via stop entry or market order. If you use a stop entry order, then your position will open automatically. However, if the market reverses at this point in a fake out, then you will incur a loss. Using a market order gives you some time to determine whether the breakout above B is genuine. You could, for example, wait a few minutes before triggering the position, although in heavy trending markets this may lower your profits. I think this one would still be the better option than this one, because at least this one doesn't say it will incur a loss. So at this point you may want to use a 5-minute or 10-minute chart to pinpoint your entry. That way you can wait for the price to close beyond B before opening your trade. Targets. This strategy targets 2 levels. The first is at 127.2% of BC. At this point you can move your stop loss to eliminate risk on the position. The profit target is 161.8% extension of BC. In a particularly strong trend, you can set a profit target at 261.8% of BC. To determine the strength of the move, look at the size of the BC retracement. The size of that. In a strong trend, it should be around 38.2% or lower. Tip: watch out for any significant support resistance levels before your profit target. If your market needs to surpass its 200-day MA before hitting the 161.8% extension, for instance, it might not be the best time to trade. Right, okay. Risk management. When you open your position, you'll want to place a stop loss order at some point on the other side of B. Its precise location will depend on your risk-reward ratio, bearing in mind where your profit target is. Your risk-reward ratio should be above 1 to 1, preferably 1 to 2 or higher. So you're basically risking, like say, £50 for £100. You don't have to wait for the market to return to your stop loss either. If you open a position at beyond B, but then spot that the market is losing momentum, it might be a better idea to close the trade and cut your losses early. Examples. Here are some examples of our strategy in action. Buying NZD AUD. Here the position opens at 0.80240 with the level 161.8%, with the 161.8% level as a profit target at 0.80590. After moving the stop to break even at 0.80383, the position is closed at the profit target. So it goes boom, 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 boom. Buy stop, you start like a little bit above that, and then boom, profit target. Oh, so you buy where that point is at. Right, I see. That distance there is C, basically. Right, okay, selling Brent crude. Oh no, buying GBP USD. In this trade, opening ahead of a key economic release. In this trade, opened ahead of a key economic release, the market moved considerably further than the profit target. The short retracement may have been a clue that 261.8% was a better target. Wait, so the market moved considerably further than the profit target. The short retracement may have been a clue, so that bit there, that 261.8% was a better target. Is that short? Is that shorter than that? Apparently it is. So boom, boom, boom. Selling Brent crude. In this example, the breakout beyond B at 10735 quickly reversed into fake out. The stop was triggered, limiting losses on this position. So it should go boom, 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 but then it didn't. So it should go boom, 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 but it went boom, 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 and then boom, 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 boom. So when boom, sell stop to prevent any further losses, basically. Oh no, you start selling here, and then boom, stop. Right, okay. This is pretty much that ABCD pattern, isn't it? ABCD. Oh well, I'll just fib trading strategy. So what's, I think this, let's do this one. Copy. That's 49.99. Like that, okay. Right, and then second target. I think this diagram explains it all, to be honest. And then we can include some of these examples. I think that will better show what happens. So here, take that. And then we can also take this, another buy example. And then this and the sell example. Right, okay, so that's that lesson done. I think this is the advanced technical analysis course finished. So, woohoo! Advanced risk management. Oh, advanced. Next, advanced strategies. So, layout is the breaks. Oh no, not breaks. Table layout below. This is the title of the thing, isn't it? Yep. So, advanced strategies, isn't it? The date is 28/01/2024. Cool. So, the non-farm payrolls, V-shaped reversal. How to trade non-farm payroll, the V-shaped reversal. Welcome to the Advanced Trading Strategies course. Advanced Trading. Strategies course. In the next few lessons, we're going to cover some strategies for experienced traders, starting with a popular method of trading non-farm payrolls. Yeah, I'm not really that, but let's just go through this anyway. The NFP V-shaped reversal is straightforward to execute if you manage your risk carefully. Apply a few basic rules and stick to them. It can provide a useful way to trade the non-farm payrolls report, which is notoriously tricky to predict with a high margin for error. Non-farm payroll and the US dollar. Counterintuitively, a strong FP report can often lead to a weakness in USD. This is because a large increase in US employment is indicative of a growing global economy, which can prompt traders to sell safe haven currencies like the dollar and buy high yielding currencies from other regions. So, strong NFP report can often lead to weakness in USD because a large increase in US employment is indicative of a growing global economy. Which can prompt traders to sell safe haven currencies like the dollar and buy higher yielding currencies from other regions. What is the NFP V-shaped reversal? The V-shaped reversal is a sharp turnaround that can arise as traders digest the non-farm payrolls reports. So, do that. summarize as traders digest the non-farm payrolls. Reports. Economic releases typically result in predictable market outcomes. For instance, if GDP growth expands more quickly than expected in Australia, AUD will rally the vast majority of the time. The NFP report, for example, on the other hand, can be much more dynamic. Economic releases, so economic releases typically result in more unpredictable market outcomes. If GDP growth expands more quickly than expected in Australia, AUD will rally the vast majority of the time. However, the NFP reports can be much more dynamic. Major currency pairs such as the USD, JPY, and EUR USD may spike in one direction in the wake of the release. So major currency pairs may spike in one direction in during release. Oh no, after release. After the NFP. Then sharply reverse in the following 10 to 120 minutes, or aka 2 hours. Then sharply reverse in the following 10 to 120. Often this new trend then continues the remainder of the session. Often this new trend with the remainder of the session. Let's watch this video.
One event that almost always impacts the Forex market is the monthly NFP, or Non-Farm Payroll Report. This is issued by the U.S. Bureau of Labor Statistics and gives a glimpse into employment changes and the labor market in the United States. The figure released represents the net number of jobs added or lost in the economy over the last month, not including jobs in the farming industry. It also contains estimates on the average work week and average weekly earnings of all non-farm employees. The monthly NFP is generally released first Friday of every month at 8:30 a.m. Eastern Time. Although the report is issued in the United States, it usually affects the entire Forex market. Contrary to what you might think, a stronger than expected NFP report does not necessarily lead to a stronger US dollar and can occasionally lead to a drop in the US dollar. The NFP is different from other economic releases where you tend to get a more straightforward outcome. For example, a strong GDP report from Australia will cause the Australian dollar to rally most of the time. There are many strategies to trade around the NFP, but a particularly popular one relies on the famous V-shaped reversal that follows in the wake of the release. This is where the market will spike suddenly in one direction as traders buy or sell safe haven currencies before reversing in the following 10 to 120 minutes in the other direction. Rather than trying to get in early and predict both the NFP number and the market's reaction, many traders will wait until initial volatility dies down and try to catch the V-shaped reversal. Like everything in trading, the V-shaped reversal is not a sure thing. Nothing in trading is. But even catching a reversal just 33% of the time can lead to a profit if you utilize a strong risk-to-reward ratio. So, rather than trying to predict the NFP number or its market impact, trading the reversal is another strategy to add to your trading. You can stay on top of upcoming events such as the NFP and their potential impact on the market with Forex.com's comprehensive economic calendar.
Okay. So we can see that there's a diagram demonstration here of the actual V spike. So the thing goes, the market goes goes here, NFP gets released here, sharp drop in the currency, and then boom, straight back up again, and then it continues going up, it seems. Carry on that upwards trend basically. So trading the V. To trade the V-shaped reversal, you hold off from opening a position as reports are released. So hold off from opening your position as the report is released. Then you can try to catch the V-shaped reversal if it arises. As it arises. As we've covered, the reversal can often lead on to a strong trend, so may offer an opportunity with a solid risk-to-reward ratio. The best method to catch the V is to watch for a reversal candlestick pattern. Reverse. That should be a green, shouldn't it? Because it goes up. On a 5-minute or a 15-minute chart. Though a reversal is not inevitable, nothing in trading is. Even catching a reversal 33% of the time can lead to profit if you utilize a strong risk to reward ratio. However, keep in mind that a reversal is not guaranteed. The plan then is to wait for a reversal candlestick in the aftermath of an AFP release, then open your position with stop in place nearby, targeting a 1 to 3 or even 1 to 4 risk to reward ratio. An example of the V-shaped NFP reversal. For a quick example, let's look at the 5-minute chart below. The NFP report is printed at 146k, beating expectations of 189k. NFP release, that's a V shape here. Stop under this low, buy zone. Goes up, target area where momentum dies down. So close the trade off somewhere around here. So EUR USD initially dropped by around 30 pips in 10 minutes after the data was released. So you can see that's here. But then a candle, and remember 30 pips is the fourth digit, I think. So, but then off that 0 point whatever it is number there, but then a hammer candlestick suggests a shift from selling to buying pressure. Remember, hammer is the one with like a square and then the handle. This candlestick pattern signaled a possible reason to enter the market on the long side. A buy order near the close of the candle around that, with a tight stop loss order below the recent low near that, would have given a low 15 pips of risk. EUR USD rallied to 1.2950, over 60 pips above the entry signal, which is around here, or here. Oh no, buy zone entry signals here. This is the one, I'm assuming 1.2950 or something. Our trader could have set a limit order based on the 1-to-3 ratio and banked 45 pips. So this is the profit limit, I think. If the V hadn't arrived this time around, you will lose 15 pips when your stop is triggered. Hence the 1-to-3 reward ratio. So 1-to-3. Okay. Open range breakout. The opening range breakout trade. Actually, let's take a photo of the thing. So like that. Copy like that. 99.99 like that. Like that, like that, and like that. Cool. Open range breakout. The opening range breakout trade. Breakouts are one of the most common trading strategies. Let's take a look at a useful way of trading with breakouts, the European opening range strategy. Generally, breakouts are used when the market is already near the extreme high or low of the recent past. When the market is trending and moving strongly in one direction, breakout trading ensures that you never miss the move. The European opening range strategy typically focuses on Euro USD, although you can apply it to any European major such as GBP USD or USD/CHF. It utilizes the fact that early market activity on a given day may set the tone for the remaining sessions. Trading the European opening range strategy. To trade the European opening range strategy, you follow these 3 steps. So what is European opening range strategy? Find the European range for the current day. To do this, you'll need to identify a market's high and low during the half hour before the London Open. Identify the high and low during the half hour before the London Open, which is that time, 7:30 to 8 AM GMT. Look for a breakout from this range. Plus or minus 10 pips You want the market to stay above or below this level for 10 to 15 minutes. Wait, you want the market to stay above or below this level, not market, for 10 to 15 minutes. This tells you the momentum direction for the remainder of the day sessions, so you can open your position accordingly. Tells you the momentum or direction of for the remainder of today's sessions. Instead of using plus or minus 10 pips, you could look for breakout plus or minus 1/10 of the market's daily average true range. Jesus. For breakout plus or minus 1/10 of the market's daily average true range. Managing this bullish or bearish sentiment. Now that you know the most likely trend direction of the market for the rest of the day, you can trade it. We recommend using lower time frames, 2 to 5 minutes, plus a combination of moving averages and oscillator indicators to watch for smaller counter trends. Recommend using lower time frames, 2 or 5 minutes, plus a combination of moving averages. And oscillator indicators to watch for smaller counter trends. Factors to watch out for. Events. Major news announcements can send any strategy awry, and then this case is no different. Make sure to pay attention to the Forex.com economic calendar and consider exiting your positions if a medium or high impact announcement is on the way. The time of day can also affect this strategy, particularly surrounding the following events. The time also affects this strategy. Particularly particularly major option expires, currency fixings, currency future closes, and the US equity markets. Major option expirations: NY expiry 10 AM local time, Japan expiry 3 PM local time. Currency future closes: International Monetary Market IMM closes 3 PM New York time. Currency fixings: London fix 4 PM local time, Tokyo fix 8:55 AM local time. US equity markets opens 9:30 AM New York time, closes 4 PM New York time. If the price is struggling near these events, typically spotted by bullish-bearish divergence of an oscillator, then it might be prudent to reduce your position size ahead of time. So if let's do that. And was it if price is struggling near these events, which is typically seen by a bullish slash bearish divergence with an oscillator with an oscillatory indicator. If the price is struggling near these events, which is typically seen by bullish indicator, it might be prudent to reduce your position size ahead of time. Average true range. As a currency trader, when volatility begins to pick up, you usually want to be trading, not sitting on the sidelines. As a currency trader, when volatility begins to pick up, you usually want to be trading, not sitting on the sidelines. You usually want to be trading instead of sitting on the sidelines. When volatility begins to pick up. As a result, if a market has yet to hit its average true range on Monday, Tuesday or Wednesday of a particular week, then it may be sensible to pay attention to this tactic on Thursday and Friday. Conversely, if the average true range is reached early in the week, it may be prudent to be on the lookout for potential failures in the latter half of the week, as they could be the market for false break or possible outright reversal. Market has yet to hit its average true range on a Monday, Tuesday or Wednesday of a particular week, then it may be sensible to pay close attention to this tactic on Thursday or Friday. Conversely, however, if the average true range is reached earlier in the week, it may be prudent to be on the lookout for potential failures in the latter half of the week, as they could be the marking of a false break or possible outright reversal, as they could be the marking of a false break or possible outright reversal. Okay. Let's see about this. Okay, so I'm gonna leave this episode here. In the next video, we're gonna go through the direct market access. So thank you guys for watching, and I'll see you then. Bye.